My name is Ray.
Hi, this is Michael.
Welcome to another episode of Ray's Economics Clue Book. Today we'll be talking about Taylor rule and how that relates to our current study of monetary policy and interest and inflation rate. So last time I talked about the loanable funds market and the monetary liquidity model, when we look at the Federal Reserve, their impact on money supply basically, and if they have quantitative easing perhaps, and they shift the money supply right, which means our interest rate goes down, investments increase, which causes our inflation to increase and our GDP to increase, which causes our output, real GDP, to be ahead of our to all other things considered equal, to be ahead of our potential output or potential real GDP, which is our long-run potential output. And basically, what this happens,
we'll call that inflationary gap.
This is one example of open market operation that results in more quantitative easing.
Yeah, in fact, the Federal Reserve can even just directly reduce that federal fund rate to have the same impact.
Yes. So economist John Taylor, he basically looked at the federal funds rate and see how that related to monetary policy and how that relates to inflation and GDP gap, because all of these are very closely tied together. So he discovered that the federal funds rate can theoretically be accurately estimated through the equation 1 plus 1.5 times P plus 0.5 times Y. P is the inflation rate of previous four past quarters, so not too hard to understand there. And Y, however, is the percent deviation from real GDP from target GDP, which is our long-run potential output. So basically, our Y is 100 for percentage-wise times real GDP currently minus our G asterisk, which is our trend real GDP or our target GDP over our target GDP for a percentage. Our real GDP, of course, is real GDP currently. Our trend GDP is basically our theoretical potential output right now, or long-run output right now, which is basically a trend from the past 50 years of measurements of real GDP measurements, and looking how that trends towards what our theoretical potential output on real GDP will be today. Now, our real GDP increases right now from previous trends around 2.5% per year. So using that trend, we can accurately predict what the potential output will be for a given year.
Yeah, I think it's pretty clear, but there are two issues that I want to raise here. Number one is 2.5% of the real GDP increase is not really just a uniform across every year. For example, right after World War II, the real GDP increased much faster than today. And after 2008, the financial crisis, the real GDP increase pretty much is very anemic. It's only about 1% or even lower. So, but in long run speaking, US GDP, real GDP increase around 2 or 2.5% roughly. That's for number two is G asterisk here is a trend real GDP. Basically, we use the G asterisk from, for example, using a moving average could be a trend indicator, right? So we can, from different trend indicator to project what is the potential output is. So we basically use a trend, estimate from our trend lines, the G asterisk, to proxy that potential output. So that we can calculate what exact GDP gap is, right? Okay, so.
So Taylor rule is usually, the Taylor rule and theoretical federal funds rate from the Taylor rule is usually very close to the actual federal funds rate, except for one particular instance that may happen again, may have happened in the past and may happen again, which is where Taylor rule, in 2008-2009 recession, the Great Recession, we had our recessionary gap was so large, our output gap was so negative that the Taylor rule theoretical federal funds rate was negative. And so our federal funds rate did not go negative, it just went as close to zero as we probably could have gotten at that point without actually reaching zero. And so there was a huge debate at this time whether the U.S. should copy perhaps Switzerland and have a negative rate on loans and savings perhaps. And we did not follow that, and we just went close to zero instead of reaching the theoretical Taylor rule, which would have been around negative 3%.
Yeah, so it's actually, there's, as Ray just mentioned, there's a lot of debate whether U.S. Federal Reserve should follow the Switzerland Central Bank or ECB, right? European Central Bank, because they both apply the negative rate. Okay, and eventually we can see Federal Reserve, they pick the massive QE, right? Massive QE too. Basically, they have if we look at our liquidity preference model, etc., we can find that actually they have very similar impact. Okay.
And so basically we have inflation targeting that derived from this. The central bank basically sets a target for an inflation rate that they can perhaps plug into the Taylor rule. And basically for right now, a 2% core personal consumption expenditure and the index rate is what a benchmark typically will look like. We talked about this. We'll talk about the PCE in previous videos. And the Fed sets policies to its monetary policies to hit this rate through transparency.
Hit this target.
And it's based on the forecast of future inflation. So unlike Taylor, which is current inflation, it's based off of future inflation to target this rate.
Yeah. So actually, right now, most of the central banks actually they adopt more strategies like inflation targeting. Okay. So basically, just as Ray mentioned, it's actually focused on we want to hit the future inflation. We want to hit as 2%. Okay. So we devise our current monetary policy to hit that target. Okay, that's actually away from Taylor's rule, because Taylor's rule focused on past inflation data to determine current policy. And right now, most of the central banks, they devise the current policy based on future projections. Okay, not just the past inflations like Taylor's rule. Okay,
So for a final clue, the Taylor rule basically it's connected to the federal funds rate with two important pillars of the Fed's consideration, which is output gap and past inflation rate.
Yeah.
Then the Fed uses future inflation rate to perhaps reach its its unwritten inflation goals or PCE goals. And so monetary policy, the advantage of this is monetary policy is usually conducted way faster than a regular fiscal policy. So it has less lag, because once the floodgates open and we go on perhaps we lower the federal funds rate or we have open market operations, the effects of the money flowing through the economy are almost immediate and a lot quicker than fiscal policy.
In addition, they don't have the political mess, right? And they can just independently move on the policy as quickly as possible. And from another perspective, financial market usually reacts much faster. For example, even just when the Federal Reserve Chair opens the mouth, then no real action, no any real action.
Financial market has strong reactions.
Financial market could immediately jump up. Then the wealth effect could be almost immediately created. So and then we call that open mouth operation, right? So basically, that's the advantage for the money policy. So today we discussed all those the beautiful John Taylor rule, basically one equation try to connect all those important elements together, so that we can better understand how how they interact with each other from the theoretical formula. So we'll look forward to see you next time.
Bye.
Bye.